Our next topic is IAS 12, which is income taxes. The income tax, this talks about other taxes also. It talks about the withholding tax. It talks about the deferred tax and the company income tax. So all these are dealt with under this particular standard. So it talks about how this should be accounted for in the books, how the necessary adjustment should be made in our books of accounts. So, and when are they, when are we supposed to recognize them in our books? So, which one are we supposed to refer to as deferred, or which one are we supposed to defer, and which one are we supposed to incorporate into the current reporting period? So, in the course of this lecture, we'll talk about the objective of IAS 12, then talk about the scope of IAS 12, definition of some key terms under IAS 12, the recognition and measurement criteria, and the disclosure requirements for entity that adopt IAS 12. Here, since tax is a compulsory levy that is either that is levied by government on individual or an entity, so it's just compulsory that all entities must adopt this. So this must be paid, except those companies or entities that are not paying tax, that are not tax deductible, which what was it called? The activities are not subject to tax of the land. So except those ones, other entities are meant to adopt IAS 12. So what is really the objective of IAS 12? The key objective of IAS 12 are to prescribe accounting treatment, how this should be treated. This we have talked about before, how it should be treated in our books. So other issues, so it has come to tell us the distinction between permanent and timing differences. So when you say permanent and timing differences, these arose as a result of distinction between accounting profits and taxable profits. The whatever accounting profit has been arrived at, for tax purpose, most times these are adjusted, because for tax purpose, instead of giving depreciation will not be considered as allowable expense under tax, so it will definitely be disallowed. So what is given in place of depreciation is capital allowance. So all these non-taxable income, like profit on disposal of non-current assets, so all the losses on disposal of non-current assets, all these will definitely be adjusted into the profit, because they are not allowed under tax. So general provisions also for bad debts or doubtful debts are not also allowed under that. So these are most things that cause the timing difference. They cause difference between taxable income and accounting income. So also this has come to even address the future recovery or settlement of carrying amount of deferred tax or liabilities in the statement of financial position, and recognizing and dealing with losses for income tax purpose. So what is the scope? What are the scopes of IAS 12? Is wide and covers all domestic foreign taxes which are based on entities taxable profit, as well as other taxes such as withholding tax, which is payable when an entity pays dividend. So it's not necessarily when dividend is paid. Withholding tax are tax deductible at source. These is a form of tax you deduct at source before you give whatever is accrued to that beneficiary, to the beneficiary. So this is a form of advance tax to the beneficiary, but you are assisting the beneficiary to pay part of the tax that will be paid in future. You are paying it now. So it's an advance tax payment on behalf of the beneficiary of such transaction, or of such income. So definition of some key terms: what is accounting profit? What is taxable profit? Accounting profit is when you take your income and you reduce your what, you reduce your expense from it, so before you charge your tax. But for tax purpose, this, there are some items considered to be expense in accounting, so which are not considered, for tax purpose in what, under taxation. So some of those items are depreciation. They are profit or loss on what, on disposal of non-current assets. These are not allowed for tax purpose, so definitely they will be what, they will be adjusted. So what is tax expense? Tax expense is the aggregate amount included in what? Aggregate amount included in the determination of what? Of net profit or loss for the period in respect of what? In respect of current and deferred tax. So, for increase in deferred tax, this will definitely do what? This will definitely, the difference, that variation, so will definitely affect our what? Affect our tax expense. Any decrease in it will also affect our tax expense. So that is why they are saying it is the aggregate amount. So it's the combination of the two. So it is only the increase in deferred tax that will affect our current tax. That's our tax expense. So not the whole what, not the whole deferred tax. So current tax is the amount of, what is your current tax? The current tax is the one you are paying within that what? Within that financial period, or within that reporting period. So that's the one that is referred to as what? As current tax. Deferred tax liability, these are the amounts of income taxes payable in future for taxable temporary difference. Because for example, say you have a PPE, a PPE, when let's say you have a PPE, so this PPE under accounting, the rate of depreciation that will be charged under accounting will be different from that will be charged under what? It will be different from that will be charged under tax. So the difference, even if you take the carrying amount, that is after reducing depreciation from the what? From the cost, if you take the carrying amount and you compare it with TWDV, that the tax written down value, how do you get your tax written down value? The tax written down value is the cost of that PPE, so definitely minus what? Minus all allowable allowances, like initial allowance, like capital allowance, let's say capital allowance generally. So when you remove your capital allowance from that, capital allowance is in place of what? Is in place of depreciation for tax purpose. So the difference between your carrying amount and your tax base, this is called tax base. So the difference between your carrying amount and the tax base is what will give you what? Is what will give you your timing difference. So whatever you have as timing difference, you apply the rate, you apply the what? The withholding tax rate, that's income tax rate. So whatever it gives you, it is your what? It is your deferred tax for that period. So any increase or decrease in it, it is that aspect, the increase in it, that will go to what? That will touch your income statement, which will definitely affect your what? Which will definitely affect your current tax, or will be treated as part of your tax expense. Sorry. So here we are saying, so in simple terms, this means that a deferred tax will arise when the carrying value of an asset is greater than its what? Is greater than its tax base. So when the carrying value of the asset is less, so it is less, or it is less, or when it is less also than its tax base. So deferred assets. So what are deferred assets? Deferred assets are the amount of what? Of income taxes recoverable in the future for deductible timing difference, deductible temporary difference, carrying forward of unused tax losses, and carrying forward of unused tax credit. So this is what, or these are what makes our deferred what? Our deferred tax liabilities. For temporary difference, what do you mean by temporary difference? I've earlier explained what temporary difference is. So these are differences between the carrying amount of an asset and what? And the of an asset or liability in the statement of financial statement, in the statement of financial position, and its tax base. So temporary difference may either be taxable temporary difference or deductible temporary difference. So where is taxable temporary difference? Taxable amounts in determining the taxable profit or tax loss of future periods when the carrying amount of what? Of the asset or liabilities is recovered or settled. So where it is deductible, that means the temporary difference will result in amounts that are deductible in determining taxable profit or loss of future periods when the carrying amount of the asset or liabilities is what is recovered or settled. But it should be noted, we should note that in consolidated financial statements, temporary dividends are determined by comparing the carrying amounts of the consolidated assets and liabilities to their tax base are determined by the reference to either the consolidated tax returns, or where no such returns is what is prepared, then you use the individual tax returns of the what of the consolidated entities. So the tax base of an asset or liability is the amount attributed to what to that asset or liability for tax purpose. So as we said when we have the cost of a PPE and we have the what and we have the capital allowance. So capital allowance minus what minus the capital allowance, the cost minus the capital allowance will give us the tax base. Under capital allowance computation, it is called what? It is called TWDV, tax written down value. That's for tax purpose. So this tax base of what? This tax base of an asset is the amount deductible for tax purposes against any taxable economic benefit that will flow to the entity as it recovers its carrying amount of the what of the asset through use of sale. So the tax base of a liability is an amount taxable for tax purpose in respect of liabilities in future what in future period. So these are things we need to just we need to get conversant with under income taxes. So we need to be conversant with all these terms. So when they're talking about tax base has to do with it has to do with amount attributable to that asset or liability for tax purpose. So here this amount cost minus cost minus capital allowance is a tax base. So when the carrying value of the liability is greater than its tax base, or when the carrying value of an asset is less than its tax base, a deferred tax asset may arise. So this means, for example, that when an accrued liability is paid in the future period, part or all of that payment may become allowable for tax purposes. So then we have recognition and measurement criteria, accounting treatment. So how are we expected to treat this in our financial statement? So the recognition and measurement criteria for current tax assets and liabilities. So what are we expected to, or when are we expected to recognize this in our statement of financial in our financial statement? So how do we account for current assets and liabilities? The current assets and liabilities should be recognized. The current assets should be recognized as follows. One is, when you want to recognize your current tax liability, it should definitely be recognized in your statement of profit or loss. So, and this will also be recognized to the extent of the amount that is being owed, to the amount that is being owed or that remains unpaid, to the relevant tax authority. Where you have paid excess of this where you have paid excess of this tax, what you need to do, you need to recognize that excess as as an asset in your statement of financial position, because it's seen that the government is doing is owing you part of that that amount you have paid in excess. Any change in your tax rate, if there is any change in your tax rate, that rate is a change in estimate. And we have said earlier that, or you still come across it under AS8, that for change in estimate, you don't do you don't adjust retrospectively, you adjust prospectively. But if it is a change in accounting policy, what you need to do is to do you adjust retrospectively and going forward. So but for change in estimate, you don't adjust retrospectively, you adjust prospectively. So that is what one needs to take note of under IS 8, that's a change in accounting estimate and error, or accounting policy, sorry. So an error. So that's what you need to just observe. Just take note that where you have paid excess, of the amount that is due to the relevant tax authority, what you need to do is that excess should be recognized as what? It should be recognized as an asset, in your, as a deferred asset in your what? It should be recognized as an asset in your statement of financial what? And in the statement of financial position. So now, to defer tax assets and liabilities. So what are we supposed to do? How are we supposed to recognize this in our what? In our books of accounts. So a deferred tax liability is recognized for all taxable temporary difference. How does it arise? It arises as a result of what? As a result of timing difference. So temporary timing difference. A deferred asset is recognized for all deductible temporary what? Temporary difference, to the extent that it is probable that they are recoverable from future taxable profit. So where it is not probable, what are we supposed to do? This will not be taken as what? It will not be taken as a deferred tax asset. So, or it will be taken otherwise. So a recent loss is considered evidence that a deferred tax asset should not be what? It should not be recognized. To account for deferred tax under IAS 12, you first prepare a statement of financial position that shows all the assets and liabilities in the what? In the statement of financial position and in the accounting statement of financial position, and their tax base. So you also show any other item that may not have been recognized as assets or liabilities in the accounting statement of financial position, but that may have a tax what? It may have a tax base